This video will work through problem 4.7 from Gapenski's Healthcare Finance 6th edition. 4.7 asks us to restate a couple of transactions on the balance sheet for Bayshore Radiology. So you need to go back to page 143 to 145 in the 6th edition to see these transactions. Probably the easiest way for us to do this is to just kind of start from transaction 1, which is the establishment of the organization, and then work through 2, 3, and 4. And they're asking us to do the transactions slightly differently. All right, so let's see. We've got a couple of ways that I would accept this as a professor that would show you that you would be able to show me that you actually understood what was going on. Let's work through it sort of in a T account fashion, and then we'll have, and then we'll build the balance sheet as we go. So the first transaction, they're not asking you to do this in the problem, but let's do it anyway. The first transaction is the owners contribute $1 million to establish the business. So we would have a T account for cash and a T account for common stock, right? And the cash would be $1 million, and the common stock then would be $1 million. And notice that the two are equal, right? And the key here with the balance sheet, all the stuff that we do with the balance sheet, is that they're always going to be kind of canceling or equalizing transactions. So from a balance sheet perspective, we'd have assets and liabilities and owner's equity over here, right? And what would this initial transaction look like? Well, we'd have cash of $1 million. I'm going to do 1,000K. And then we would have common stock of $1 million. Right. And the two are equal, right? If we add these two columns together, 1,000 equals 1,000. So it's pretty straightforward. Now we do the first transaction, which is purchase of equipment for cash. Okay. But in this case, well, I'll go ahead and I'll do what the book does. So no, I won't, because it'll mess us up. All right. So transaction 2, the $200,000 in equipment purchase is made with long-term borrowings instead of cash. Okay, so we're buying equipment, and we need an equipment T account, and we need long-term debt. Long-term borrowings. We'll just call it long-term debt. Okay. Well, the equipment is an asset, and it's $200,000. So $200,000, and the long-term debt is in the same amount. If I'm buying it all with long-term debt, then I'm buying $200,000 in long-term debt. So I'm going to rewrite now a new balance sheet that incorporates all this. So I have my assets. I still have my cash of $1 million. I now have equipment worth 200, and I have long-term debt of 200, and I have common stock of $1 million. So when I add those up, I have 1.2 million on this side and 1.2 million on this side. Okay. Transaction 2, $20,000 in supplies are purchased with cash instead of on trade credit. All right, so I'm going to purchase $20,000 in supplies. So I need a supplies T account, and supplies are an asset. So I'm going to buy 20,000 in supplies, and I'm going to use 20,000 in cash to do it. So I'm going to credit my cash account 20,000, and then I'll balance it out. And so now I will have 980,000 in cash. And I have supplies. So I need to write a new balance sheet here. I'm going to probably run out of space in a minute, but let's recast it. So I now have cash of 980. I have inventory of 20. Total current assets of 980 plus 20 is 1,000. And then I have equipment, which would be my property, plant, and equipment line of 200 for total assets of 1.2 million, right? Nothing has changed on the liabilities and owner's equity side, right? So I still have long-term debt of 200 and common stock of 1 million. So all of the both sides of the transaction for this transaction 3 happened on the asset side. All we did was take our cash and turn it into inventory. So there's no net change here. At the end of the day, right, we still have 1.2 million, which is what we had when we started. All right, I'm going to need another sheet of paper here. Transaction 4, the 50,000 in services provided are immediately paid for by patients instead of billed to third-party payers. So 50,000 in services provided are immediately paid for by patients. So what does that mean? That means that we have revenue, another account, right, of 50,000. So we'll book 50,000 in revenue as a credit, and we'll debit cash 50,000, so that we now have 1,030,000 in cash, 50,000 in revenues. But revenue is not a balance sheet account. It is a income statement account, right? So from chapter 3, we do income. So what does it, if nothing else happened this year, if that was the only transaction on the income statement this year, what would happen what would the balance sheet look like as a result of that transaction at the end of the year? Well, if we had revenue of 50 and we had no expenses reported, then we would have net income of 50, right? And if we assume, again, nothing else happens, which would mean that the organization doesn't pay out any dividends, then that net income would become retained earnings of 50. Okay? So what we're going to do here now is do our final balance sheet, right, where we have assets and liabilities and owner's equity here, and we have cash of 1,030. We have supplies or inventory. I think I said inventory last time. Doesn't matter. Supplies or inventory is fine. Supplies and inventory of 20,000 for current assets of 1,050. Equipment, property, plant, and equipment of 200. We now have total assets of 1,250. Okay, let's look back here for a second. At the end of the last period, we had total assets of 1.2 million. They've now increased to 1.25 million. So that means that something over here has gone up. Well, that something over here is the retained earnings. So we have long-term debt of 200. And that's all of our long-term debt of 200, and that is all of our liabilities. Then we have equity, and I've got now two different equity entries. I have common stock for $1 million, and I have retained earnings of 50. Okay, so then we just total this up. So total liabilities and owner's equity is going to be 200 plus 1,000 plus 50, or 1,250. Okay. So once again, we have balance. This is a tricky one here. The book does it this way. So the assumption when you're making an entry like that is a transaction like that, the way the book is teaching you, you have to follow the transaction all the way through to its logical end, assuming that no other transactions happen. So all other things equal, as economists like to say, then a revenue of 50 translates into a net income of 50, which translates into a retained earnings of 50. If we don't know any other transactions, then we would have retained earnings of 50, which would be an increase in our equity account of 50, and would increase our total liabilities and owner's equity of to 1,250, which then balances off our total assets account.